Welcome to Ragtrader Connect, powered by KORNIT. Week 2. Think strategically with the Alceon Group's Richard Facioni.
So how did we decide to invest in Noni B? I was aware of Noni B as a business. My mum used to shop there when I was a kid, but that was about it. It certainly wasn't on my investment radar. In fact, retail as a sector wasn't on my investment radar. But I was introduced to Noni B by what is now Mosaic Brands by Scott Evans. And I'd been introduced to Scott as a potential CEO that I might be interested in working with and looking at investment opportunities, notwithstanding that his background was retail. The person introduced us said, hey, he's a good guy, you should meet him. So we met one evening, and I'd only just started at Alceon. It was probably March of 2014. We met in my boardroom one evening after work. And we sat there and chewed the fat and had a chat and kind of sized each other up. And I'm sure he was thinking what I was thinking, who is this guy and why am I here? But I then asked him the question that I like to ask all my potential CEOs when I partner up with someone, and that is, if you had a blank checkbook, if I gave you a blank checkbook right now, what would you buy? And his immediate response was Noni B. I was like, okay, well, that's pretty interesting. And I asked him why, and he kind of explained why. And I thought, okay, well, that kind of sounds interesting, but it's still retail. I don't know if there's really anything in that, but interesting thought. That was pretty much it. We shook hands that evening and said goodbye. Didn't know if we'd ever see each other again, to be honest. And in fact, if I ask him today, what was your takeaway from that meeting, his response is, he went home that evening, and I don't know if any of you have parked in the Sydney CBD, but if you have, you'd know that it doesn't take very much to rack up a $100 parking bill. He went home that evening, his wife asked him, so how was your meeting? And he said, well, there's $100 I'll never get back. And my reaction after the meeting was, well, interesting guy, but retail, really? I don't think so. And that was it. So then what happened? Probably 2 or 3 months later, Noni B made an ASX announcement that they were undertaking a strategic review. And of course, that's code for we're in trouble and we're for sale. So I knew at that point it was for sale. Now, it was still retail. It still had, I still didn't quite understand whether there was an opportunity here, but being the opportunist that I am, I thought, okay, well, if there's something there, let's have a look at it. So I picked up the phone, called Scott, and said, Scott, do you want to have a look at it? His immediate reaction was, well, how do we do this? And I said, well, you worry about me about how we do it. Do you want to run it if we do it? And I gave him the weekend to think about it. He thought about it, came back on the Monday and said, yeah, let's have a look at it. So then I needed to convince a whole lot of people to do the deal, to make the investment. And who did I have to convince and how did I go about it? I mean, firstly, I had to convince Scott and his management team. And he did have a team of people that he potentially was going to bring along. But I needed to convince him that it was an interesting opportunity for him. And how did I go about that? I needed to make him feel like an owner-operator. I needed to give him skin in the game. I gave him equity. I put in place very generous short-term and long-term incentive plans to make sure that he and his team were motivated, were incentivized, were clearly felt aligned with Alceon as investors, and there was a real sense of partnership there. I then needed to convince my investment committee and indeed my investors to look at this opportunity. How do we go about that? Well, we had to develop a very, very simple investment thesis, and this is where working in partnership with Scott and his team was really important. We were able to put together a very clear, very simple investment thesis that revolved around 3 key components that we knew we could control. And that was key. We were relying on things that we knew were within our control, and there were only 3 of them. And that's what made this an investable opportunity, something we could clearly explain to our investors, our investment committee, to say, hey, yes, it's retail. We know we don't like retail, but here's why this is a good opportunity. And here are the 3 things that we're going to do that we know we can deliver to achieve that outcome. And those 3 things were very, very simple. It was about improving cost of goods sold through better sourcing. It was about improving costs of doing business by reducing the overhead structure at head office. And it was about improving the rent costs, because we knew that they were paying way too much for rent, and a lot of the properties or a lot of the stores were no longer on lease; they were on month-to-month leases, and so we knew we could renegotiate those rentals. So those were 3 things that we knew were within our control. It wasn't 10 things, and we weren't relying on improving sales. In fact, our investment thesis had us losing sales, a very conservative approach. We weren't relying on chasing new customers. We weren't relying on moving into new market segments. It was a very, very simple investment thesis. That's what got it over the line, backed up by the fact that we had a very driven, committed, motivated management team with skin in the game. That's what got our investors, our investment committee over the line. Of course, we then had to convince the vendors. And the great thing about Noni B at the time was, even though it was publicly listed, it was effectively a family business. We had the two Kindle twin brothers, David and James, that were running the business at the time. We had Alan Kindle, their father, who was the founder of the business, as chairman. The Kindle family owned 40% of the business, so it was a family business. And so what that meant was it wasn't a faceless, nameless transaction. We had to navigate the personalities. It was very personal at times, and we had to navigate those personalities to get the deal done, which we subsequently did. So once we got control of the business, what did we do? And I think this is where people do get it wrong. But for the first 12 months after we bought that business, we were focused on delivering our investment thesis and nothing else. So we're focused on improving cost of goods sold, we're focused on improving cost of doing business, we're focused on renegotiating rents with our landlords. Yes, we traded the business to achieve sales targets and margin targets, but they were tactical decisions. We weren't making long-term strategic decisions about improving sales. We were focused on achieving those three things in the near term. So investing in the brand, making the shops look better. These are easy things to do, and you often see people buy business and say, well, if I make the shops look better and if I invest in the brand and reposition the brand, I'll achieve a great outcome. To us, that's dangerous territory because we're relying on things that we don't control. We just focus on those things that we could control. So we focused on cost of goods sold, cost of doing business, and rents. What they did was they created a profitable business and they generated free cash flow that we could then subsequently use to reinvest back in the business and look at those more strategic things. So then polishing up the brand, looking at store fit outs, understanding the customer, how could we better serve her, they were all things that would come later and did come once we delivered on our investment thesis. So we were very, very disciplined in those first 12 months, just being very focused on that investment thesis. Once we achieved those short-term objectives, what came next? Well, that's when we started to focus on the longer term. We started to focus on growth, both organic and acquisitive. We did start to look at improving the store format. We did start to look at reinventing the brand at the margin, not a wholesale reinvention. We did start to look at the customer. Who was she and how do we find more of her? But we also started to look at acquisition opportunities, and they started to present themselves to us. And we didn't go chasing them, they presented themselves. But what we had done, what we realised, and we didn't really know we'd achieve this going in, but what we realised at that point is that we had created a very efficient sourcing platform and a very efficient back office that we could leverage across other businesses. So when acquisitions started to present themselves, we thought, okay, we should seriously look at them. And the first cab off the rank was, of course, Pretty Girl Fashion Group. When we did that acquisition, it took us from one brand to 4 brands. Now that's transformational because you now have a CEO who is really managing just one brand who now has to manage across 4 brands, and that means putting in place a new layer of management as well. That was a big decision for us. We went from 1 brand to 4 brands and we effectively trebled the revenue of the business. But we knew, again, we're saying this, apply the same disciplines. We knew there were opportunities in cost of doing business and we knew there were opportunities in sourcing and improving the cost of goods sold. So through those things, we knew we'd end up with a more profitable business. We did that. Then along came Specialty Fashion Group, which took us from 4 brands to 9, and again, trebled our revenue, and again, forced us to revisit our management structure and what more did we need to build into our management structure to cope with this much larger business. So that's the story of Mosaic Brands from inception to where we are today. But I guess, it's easy to ask the question, well, after all that hard work, the share price today is well off its highs. You've walked from your profit guidance. What's happened? And I have to say, it's easy, it's a fact of life, and it's easy to become disillusioned and to think about all that hard work and to think, well, has it all gone to waste? But, we sit down and we look at where we are today, and why are we where we are? It's because We had bushfires in the lead up to Christmas for a number of months. We then had floods. We then had coronavirus, and they were all in quick succession of each other. In fact, they even overlapped. So we've been in a period of crisis management now for at least 6 months. But there's no question that all the hard work that we did in creating a highly efficient business is what's allowing us to weather the storm and to get through this crisis. There's no question not all retailers are going to survive what we're going through at the moment, but we know we will, and we will because of the efficiencies, the inherent efficiencies that we've built in our business. So this period is also allowing us to look more closely at the business, to accelerate some areas of growth that have been perhaps not had the opportunity to grow in the past because we've been so focused on growth by acquisition and we've been so focused on achieving those efficiencies and growing our store portfolio. But now we're seeing real opportunities in online. We're seeing real opportunities in growing our offering, our product offering to our customer through online. So that online strategy has been accelerated because of what we're going through. It's also allowing us to take a step back, look at the business strategically, and to look at the store portfolio and say, how do we now best position ourselves so that when we're through this crisis, we're in the strongest possible position we can be. So it's only because of all the hard work we've done over the last few years that's allowing us or giving us the luxury now to do those things. So to summarise, how do we spot opportunities and how do we go about turning around retail businesses? So what are the key lessons from Mosaic Brands? I think first and foremost, have a really, really simple investment thesis that's focused on 2 or 3 key levers that are within your control. Don't build an investment thesis around things that you can't control. Don't build it around currency improving. Don't build it around improving sales or attracting a new customer segment. Those things are really, really hard. You might be able to pull it off, but it's very high risk. If you want a lower risk strategy, an investable strategy, you want to focus on 2 or 3 things that are within your control. Get those things right, then you can start to focus on the icing on the cake, the blue sky stuff that delivers the super returns. But focus on those 2 or 3 things. So that's key point number 1. Number 2, you've got to have a really strong, incentivized, motivated management team. You've got to have a management team that acts and thinks like owners. This management team every day has to wake up and think, how do I improve the value of this business? Because they're improving their own net wealth. Every dollar that they spend, they have to feel like it's their own dollar that they're spending. When you've got a management team that starts to act and think like that, that has a true sense of alignment with the investors in the business, and there's a strong sense of partnership, you're on a winner. And that's what we've achieved with Mosaic Brands, no question. And thirdly, focus on businesses that have a very clear defensible market position, and preferably with few competitors. I mean, the segment that the Mosaic Brands play in, they're not sexy segments. They're not the segments that a lot of international brands want to go after. And that's fine. We like that about Mosaic Brands. It focuses on parts of the market that other people aren't that well focused on, or that are underserviced by other competitors. We like that about Mosaic Brands. It's got a very strong regional presence. Often in some country towns will be the dominant or the major women's apparel retailer in those towns. We like that about Mosaic Brands. So we like the fact that it's got a very clear market position and it's defensible and it's not that attractive to a lot of our competitors. That's what we like about it. So if you can get those 3 things right, I think that's a starting point to achieving a good investment outcome when you look at these retail businesses. It allows you to create the profit, to create the cash flow headroom that allows you to then reinvest in the business, to then start to look at organic growth or acquisitions. It doesn't mean that any of that's easy, by the way. I mean, it is hard. Retail by its very nature is hard, but don't make it any harder for yourself. And that's why that's our approach. We focus on those 3 things. That's how we've managed to get it right so far. And hopefully that's how we'll manage to continue to get it right in future. Thank you for your time.